Hi, Cindy. How are you doing today?
I'm well, Gilbert. Thank you. And thanks for taking the time to have me on.
Yeah, so thank you for being here. Maybe you can start off just by giving us a bit of an overview about your company, Saturn Oil and Gas.
Absolutely. So, Saturn is an oil weighted producer, and we've got a long runway asset base with low declines in Saskatchewan and Alberta. Production today is around 39,000 BOE per day, and it's 85% oil and liquids. So, we are very minimally exposed to natural gas. We are focused wholeheartedly on expanding per share metrics by efficiently and using innovation and technology to develop our mid-life cycle assets. So because of this, we've got a proven blueprint and we've been able to acquire assets at a discount to build out our company. And that allows us to capture synergies, reduce costs, and technically realize outperformance from our wells, thereby unlocking value that others may have missed.
So talk us through about Saturn's plans and strategies in terms of allocating capital. So how do you think about your 113 million cash on your balance sheet?
Yeah, absolutely. So our capital program and our focus on per share value is really driven to try and increase our adjusted funds flow, which is a proxy or the same thing as cash flow. So our adjusted funds flow after CapEx gets you to the free funds flow, and that's a number that investors are very interested in today. What's your free cash flow? What's your free funds flow? So we aim to, from our capital allocation, we aim to allocate about 50% of our free funds flow to debt repayment. The other portion we would allocate to our share buyback and tuck-in acquisitions, because the share buyback with those tuck-in acquisitions, and tuck-ins are, typically quite small, but they would bolt on land to existing asset areas where we're already having really good performance. So basically just expanding your footprint around an area where technically we're seeing outperformance from the wells. So the cash on our balance sheet is really helping to keep our net debt, to reduce net debt, because when you think about net debt, it's your debt less your cash. So by having that stockpile, it gives us financial flexibility. It helps reduce the net debt, and it really provides a buffer as we're executing these per share metric improvements.
So I realized that you have done a recent acquisition. So how does this recent acquisition of Battrum and Flag Lake assets to fit into your expansion into southern Saskatchewan?
Yeah, exactly. So we've had core operations in our southeast Saskatchewan area, and the Battrum and Flat Lake really fit in perfectly. So we bolt on the Battrum assets into our southeast Saskatchewan, and the Flat Lake assets, sorry, the Flat Lake assets into our southeast Saskatchewan, and the Battrum assets are our west central Saskatchewan. And that acquisition increased our oil production by about 50%. It was again acquired at what is a discounted valuation, so under 2 times cash flow. These assets are very low decline, they're oil weighted. That helps us enhance our scale and margins in the area. Plus, it gives us a longer production life because of those.
So I believe you've done some adjustment to the hedging book recently. So what's the strategic consideration that drove Saturn for that decision and to respond for the oil price volatility, and how will this impact your company's financial stability?
Yeah, great question. And it was something that was profiled in the quarter. So, just a bit of background. At the time we did the Battrum and Flat Lake acquisition that we were just speaking about, we took that opportunity to refinance the debt that we had outstanding, which was, it's always a good thing to have the debt, but it was more
Mm,
punitive. It had a
mm.
higher interest rate, and it had some very restrictive requirements for hedging that made us hedge 3 years out. So what we found is that when we were able to refinance this debt, we had some hedges on our books from the legacy debt position that was punitive. It was hurting our adjusted funds flow because the pricing was so low because it was done so long ago. So we took the opportunity in the third quarter, given we had cash on the balance sheet and we were generating good adjusted funds flow, to buy out or monetize those hedges and basically get rid of them. So it cost us $20 million. And that's because we saw oil price dip. So we were able to be very nimble, take those hedges out. And what it did is it positioned us for more upside exposure going forward. And again, had we waited and done this monetization when oil was, say, 70 or 80, it would have cost us, $10 million more at least. So we were quite opportunistic in finding a good moment to be able to clear that out. So we are now very well positioned from a hedge perspective without that punitive drag, I guess, on our adjusted funds flow.
Well, another thing that we actually noticed in Q3 is that you initiated a share buyback, your company. So how does that align with your company's shareholder value and long-term strategy?
Yeah, absolutely. So with available cash, we've got continuous free funds flow generation. We feel the buyback is a really efficient use of our financial resources to return capital to shareholders. And because of our discounted valuation in the marketplace, buying our own shares is buying almost the cheapest barrels that anyone could get on the market. So we believe in buying back our shares as a way to return capital to shareholders. And through the third quarter, as well as up to kind of present day, we've actually returned $5.4 million to shareholders by buying 2.2 million shares.
So definitely that provides some confidence to the shareholders for Saturn Oil. So in this, this is the final question I'd like to ask you, because we saw you put out the financials recently, and can you share some of the production highlights and why investors should consider investing into Saturn long term?
Absolutely. So we set a number of records in the third quarter that we're very proud of. So corporately, we had the highest production we've ever had at 39,000 barrels a day, or BOE per day. And that is within our guidance. So we had guided the market towards 38 to 40,000, and the analysts had thought we'd come in maybe 38.5, and we beat their expectations by coming in at 39. We had record adjusted EBITDA of 136 million, record adjusted funds flow of 94 million. And the 94 million is actually after we had to take this one-time $20 million hedging monetization cost. So if you look at it from a run rate perspective, and you add back that 20 million, it was really 114 million of adjusted funds flow, very healthy. As I said, we bought back 2.2 million shares. We invested $80 million into our capital program, and that drilled 48 gross wells. And heading into the fourth quarter, we're really well positioned to continue with that momentum. We're seeing strong outperformance from our wells and really excited about deploying capital in the fourth quarter and seeing where we exit the year.
So this is really exciting times for investors to start following your company, Saturn Oil, for sure.
Absolutely. We think that it's a great time for someone to take a first look at Saturn, or maybe a closer look at Saturn, because where we're valued relative to our peers, we think there's an opportunity for a re-rate in the stock. And so now's a great time, we think.
So thank you for your time, Cindy, for sharing your story with us here today.
Thank you, Gilbert. We appreciate it. And I hope you have a great rest of your day.
Yeah, you too.